Hello all and welcome you again in the series of lectures of Financial Accounting and Analysis. I, Dr. Shikha Jalota, welcome you for this session. So we have to take up the new topic, that is depreciation. In the previous topic that we have covered is we studied the final accounts. Now we will take up the next topic, that is depreciation. As depreciation, we all know very well that it is a very general term we use for depletion of the value of assets or anything in the common language. So if we talk about the literal meaning of depreciation, by literal meaning we means anything which reduces its value with the passage of time, that is called as depreciation. So if we talk about this depreciation in the terms of accounting terminology, or in the terms of recording such things in the books of accounts, then depreciation has has the same meaning, but it has certain treatments that needs to be shown in the books of accounts. So let us take this word depreciation for the accounting purpose. So as we all know that in accounting terms, depreciation can be defined as the reduction of recorded cost of a fixed asset. So when we talk about depreciation, obviously the depreciation is related to a certain fixed asset. So any current asset is not treated for the depreciation, but it is the fixed assets which will be taken up for the depreciation. And this depreciation needs to be shown in a very systematic manner until the value of the asset becomes zero or negligible, or after its like estimated life, or if it has been sold off during its life in the of the business, then this depreciation will be you can say stop showing in the business. So depreciation, if we say, it is nothing else but showing in the books of accounts that how much the assets value is getting deteriorated with the passage of time, with the usage of the asset, and it needs to be recorded throughout the life of the asset till it is there with the business, from the day it has entered the business and the day it is leaving the business, or the estimated life is over. So as you can see under the second point, an example of fixed assets are building, furniture, office equipment, machinery, etc. Any fixed assets that the business has, for the physical asset we are talking about, any fixed physical asset that the business has, they all are prone to depreciation. But there is an exception, as you can see here in this point also, there is an exception for the depreciation in the assets, and one asset which is usually not treated for the depreciation is the land, because the land is the asset which is exception to this, because it usually increases in its value with the passage of time rather than being treated for depreciation. So this is a asset, usually this is the only asset which shows the increment in the value, otherwise all other assets are showing depreciation. So we can say that this concept of depreciation applies only for the fixed assets where there is an exception of land. Otherwise, it applies on all the other fixed assets with the business, and the building, the office equipments, the machinery, the plant. These all are the assets with the business that depreciates heavily during the lifetime of the usage of the asset. Then the next point says that depreciation allows a portion of the cost of a fixed asset to the revenue generated by the fixed asset. Now, this is the accounting treatment for the business in reference to depreciation, that when depreciation is being charged, it is first of all, there are two treatments of this depreciation when we talk about the accounting treatments. One is that depreciation is showing against the value of the asset. That simply means that if you are showing depreciation amount in the books of accounts, it will reduce the value of the asset. So for example, if you have purchased 1 lakh rupee machine, and that 1 lakh rupee machine is for 5 years with the business, and suppose you are making 20,000 per year as the depreciation amount. So depreciation will make your value of asset go down with the time. So at the end of the first year, what you will do, 1 lakh rupees is the value of the machine when you have purchased it, you have used it for 1 year. Now 20,000 rupees depreciation will be charged against that asset, and now after the usage of 1 year, the value of machine will get down to 80,000 rupees, because 20,000 will be treated as the depreciation. So this is the one treatment of depreciation by which you directly reduces the cost of your asset or value of your asset by the amount of depreciation you are showing for that particular year. There's one more treatment of depreciation that needs to be there in the books of accounts. It is under the P&L account. So under P&L account, when you show the depreciation, it will be considered as an expense and will be shown on the debit side of the P&L account, as we have done in the final accounts also. So what you have done, you have treated that amount of depreciation under the debit side of the P&L account, assuming it to be an expense. So that expense is what? It is a certain portion of profit kept aside for the purpose of the depreciation. So what you are doing now, you can relate this line with that treatment, that depreciation allows a portion of the cost of a fixed asset to the revenue generated by the fixed asset. So why it is saying that the revenue generated by the fixed asset? Because when you are doing the business, you are maybe using that machine for the business, you are using that machine definitely for the business purpose. So that machine might be giving you some production, and that production you are selling, and then you are receiving the sales revenue which you are recording on the credit side of the P&L account. So when you are recording that revenue on the credit side of the P&L account, and you are showing depreciation on the debit side, what it simply says that you are reducing your revenue. This is what we have discussed in the final accounts also, when we were discussing the P&L account, that whatever revenue you have generated should be shown on the credit side, and whatever revenue you are whatever expense you are doing should be shown on the debit side, including trading and P&L account both. So when you are receiving the revenue, you are showing it on the credit side, and whatever expense you are doing in reference to receiving that revenue, that you are showing on the debit side. So if you are showing depreciation also under P&L account on the debit side, that means you are showing one of your expense for receiving that revenue as depreciation also. So why we are showing it? Because we are consuming that machine for making the for making some revenue for the business. So that running expense, that expense of the machine which has been consumed for the purpose of producing or for purpose of running the business, that should also be considered as an expense for running the business. And that is why, this is the reason why we treat depreciation as an expense and will write it on the debit side of the P&L account. So this is the logic behind this third point. This is an important point, as I have bolded it also. So it further says that this is mandatory under the matching principle, as revenue are recorded with their associated expenses in the accounting period when the asset is in use. So obviously this is saying what? It is showing, it is the matching principle, which says that whatever revenue you have received, you have to adjust it with the associated expenses that you are doing for earning that revenue. And since depreciation is one of the expense that has been incurred in order to earn the revenue, that is why it has been shown under the debit side. And also it is reducing down the value of the asset, because after usage, the depreciation is always applicable in the asset, because after usage the asset value is declining. So this helps in getting a complete picture of the revenue generation transaction and its related expenses also. Moving ahead. Now we can come to the causes of depreciation. Causes of depreciation here are, you all know, it's a very general thing that why the depreciation occurs. Obviously, it is because of wear and tear, because assets get worn out or torn out on account of constant use, and as is the case with the plant and machinery, furniture, fixtures, etc., which are used in the business or the factory. The next is exhaustion. Exhaustion here means like an asset may get exhausted through working. So when we say that on account of continuous extraction of minerals or oils, a stage comes when the mines, etc., wells, etc., they become they have less resources left, and they are under exhaustion. So exhaustion here means when the asset is getting used and it is reducing down in the value, or less, you can say less resources left for the consumption. Then obsolescence. Some assets are discarded before they are worn out, as because of the changed conditions. Maybe some old machine has been become obsolete, and because the new technology is available, new methods are available, so new machines, new methods, new technologies are replacing the old machine, old technologies, which is called as the obsolescence. Then efflux of time means certain assets get decrease in their value with the passage of time. This is true in the case of assets like, you can say, patents, copyrights, leasehold properties, etc. Then you can say accidents. Accidents also occur in the factories or at the business places also, which may depreciate the value of the asset, or you can say which makes the asset no more usable for the business. So that old asset get replaced by the new asset, because that asset is not of any use due to the accidents. So these can be the reasons why the depreciation happens. And moving ahead with other features of depreciation. Features of depreciation here means the first point which applies for the depreciation here is the term depreciation is used only in respect of fixed asset. Yes, of course, it is true, because the current assets may it may also lose value, you can say, but the time duration is so you can say so small, and since their depletion in the value is not as such very minor changes, and so it doesn't require any recognition. If we talk about the depreciation here, loss on account of fall in the value of assets for the longer term is considered as depreciation, not of the current assets. Then next point, it says depreciation is a charge against profit. Yes, depreciation is a charge against profit, because it simply means that true profit of the business cannot be ascertained without charging depreciation, because it is also one of the expense that is the business is incurring while purchasing the asset, and that asset is in turn getting used by the business for the future purposes in the business only, maybe for production, maybe for any other purpose. So if that asset is getting used in the business, and the asset is its value is getting reduced due to that usage, so that with the value it is getting depreciated, that is one of the considered as one of the expenses against the profit, against the revenue that the business is earning. So of course depreciation should be charged against the profits. Then depreciation is different from maintenance, because maintenance expenses are incurred for keeping the machine, or you can say asset, in a state of efficiency. However, any degree of maintenance cannot assure that the asset will never reach a stage of state of scrap. So of course good maintenance delays this stage, but it cannot absolutely prevent it. So depreciation is in the nature of the fixed assets, which should be treated in the books of accounts. Then all fixed assets, with certain exceptions, for example land, building, etc., suffer depreciation, although the process is very gradual. Yeah, this is again a very important aspect is that there are certain assets which do not depreciate, rather their value appreciates over time. So any asset which do not depreciate should not be shown, depreciation in reference to those assets should not be shown in the books of accounts. Moving ahead, then it says depreciation calculation. Calculation of depreciation is basically based upon these 3 points. One is the useful life of the business. Useful life here means that once the asset has been purchased for the business, then when you purchase the asset, there is always an expected life of the asset, like 5 years, 10 years, 15 years. So whatever is the useful life of the business, of the sorry asset, accordingly the business decides that how much depreciation should be calculated for every year, or which method of depreciation should be applied, or what amount of depreciation should be applied every year, accordingly according to the like life of the asset. As well as there is one more thing that is being considered. As you can see, the last point written here over here is the cost of the asset. So cost of the asset means at what price the asset has been purchased. So the price at which the asset has been purchased includes its original cost at which it is purchased, plus also it includes any sort of installation charges, any sort of transportation, shipping, preparation, setup, any expense that has been given, that has been paid by the business in order to make that asset workable for the business, that will be included in the original cost of the asset. Let's suppose, for example, this we have discussed in the previous sessions also. Let me discuss it again. For example, if we take up certain machine for 1 lakh rupees, and let's suppose 5,000 extra rupees has been spent in order to install that machine. After that, that machine will be workable for the business. So the cost of machine for the business will be 1 lakh 5,000 rupees, because 1 lakh is the original cost plus 5,000 has been spent to make it workable for the business. So the final cost for the business will be 1 lakh 5,000. So here the cost of the asset will be considered for the purpose of calculating depreciation. Then we have discussed the useful life. How much will be the useful life of the business? Accordingly, the amount of depreciation will be decided. And last important thing is the salvage value. Salvage value, or you call it as the scrap value. That is the value of the asset at the end of the useful life of the asset. So the company may consider this at you can say at the time of selling out the asset to the other party, that how much is the salvage value, and this salvage value will be considered while calculating the amount of depreciation that is to be charged for the by the business every year. So this is it for the depreciation calculation purpose. Then we'll move to other different methods of charging depreciation. You can see here there are a number of methods written here which are used for charging depreciation. But out of this, the important ones are either the straight line method or the diminishing value method, which is being usually adopted by the business in order to showing off their depreciation in the books of accounts. So we will take up depreciation methods in the next lecture. Till then, keep revising what we have done today in the depreciation, and in the next lecture we will take up the methods and we will try to solve the questions also based on that. Thank you. Till then, be in touch.